and accruing, but which have actually not been paid, and the other is expenses which are incurred in advance. That means you have already paid the money, but they do not relate to this year. So in both cases, adjusting entries need to be passed. So in the first case, where expenses have been incurred and accruing, for example, rent, interest, local taxes, wages, etc., though they have paid in the next accounting period, they have to be accounted for as expenditure pertaining to this year. For that, what we do is we debit the appropriate expense account. If it is wages, we debit the wages account and transfer it and credit to the expenses accrued account. That means it is an expenditure which has been incurred but not yet paid, and which will be reversed at the beginning of the next accounting period. Similarly, in the case of expenses incurred in advance, for example, if you have already incurred expenses in respect of rent, insurance, etc., we have paid for the next accounting period also, that needs to be taken out. That means we need to credit the appropriate expenses account, because part of the expenditure relates to another accounting period. So you credit the appropriate expenses account by debiting the a new account known as expenses prepaid account. That means expenses which have been paid in advance, that account is debited. So the entry to be passed is expenses prepaid account debit and credit to appropriate expenses account. Similarly, in the case of income, we have two types of income. One is income accrued and accruing. That means income which has accrued to you but you have not yet received the money. That means this income pertains to this accounting period. And second is income received in advance. That means you have already received the money, but it does not pertain to this accounting period. In respect of both these types of income, we need to again pass adjusting entries like we did in the case of expenses. In the case of the first one, income accrued and accruing, we have to debit what is known as the interest accruing account and credit to the appropriate income account. That means, let us say if you have made interest on, let us say, government securities which has accrued to you, but normally government pays interest only at half yearly intervals in the month of June and December. So if you are going to get interest in June, for the first 3 months that interest is accrued to you, but you have not received it. So you credit it to that interest account. So that is taken as income. In the case of income received in advance, the opposite is true. You have to debit the appropriate income account. That means though you have received it, it does not pertain to this accounting year. So you debit that appropriate income account, whether it is discount or interest, and then credit it to income received in advance account, and it is taken over to the next accounting period, where at the beginning of the next accounting period this entry is reversed. So we have, as we have seen, two adjusting entries for expenses and two adjusting entries for incomes. So similarly, we have to do some adjustment in the case of stocks of materials on hand. Normally these relate to stationery, advertisement, material stores, etc., the cost of which has been debited to expenses account. Normally what happens is, whenever an entity buys, let us say for example stationery, as and when stationery is bought, it is debited to the stationery account, but the entity may not use the entire stationery during the year. Some stock will be left at the end of the year. That means that particular value which relates to the stocks on hand is an expenditure which is related to the next year. That means this stationery is going to be used in the next accounting year. So that has to be removed from the stationery account debit balance, which has already been debited to the stationery account. So we have to pass appropriate entries. So we have to debit the stock of materials account and credit it to the appropriate expenses account. To that extent, the expenditure under that head will go down. Similarly, in the case of provision for bad and doubtful debts, we have to debit the profit and loss account and make provision for bad and doubtful debts, because if you think that certain debts are likely to become bad and doubtful in the future years, we need to provide for that, and that provision is kept separately, taken away from the profit and loss account. So by debiting profit and loss account and keeping it aside, you are making a provision for bad and doubtful debts. And then similarly, provision has to be made for discount. So you debit profit and loss account, then credit discount account. Provision for depreciation also has to be made. As we have seen, in the case of fixed assets, it is a capital expenditure, but we need to take that part of the expenditure which relates to this particular accounting period on account of wear and tear and use of the asset for that particular year. So depreciation is calculated based on certain methods, and depreciation account is debited because this is an item of expenditure, and the appropriate asset account is credited. And once that is done, the depreciation again has to be reversed by taking it to the profit and loss account. So we pass another entry by crediting depreciation account and debiting the profit and loss account. Ultimately, this item of expenditure finally finds its way to the debit side of the profit and loss account. So with this, we complete our discussion on trading and profit and loss account. So as we have seen here, we started with a trading account to arrive at the gross profit of the organization. We also considered as to what are the different entries we need to pass in order to close the books up to the trading account stage, and thereafter we took up the profit and loss account, where the gross profit earned on the trading account stage is transferred to the profit and loss account, and after that all other expenses incurred in the case of selling of goods or administrative expenses, financing expenses are taken to the profit and loss account, and all those accounts are closed by passing various entries. We also considered the adjustment entries which need to be made on account of the principle that only those items of income and expenditure which relate to that particular accounting period need to be taken to the profit and loss account. So we need to separate those incomes which are received in advance, those incomes which have accrued to the entity but not received, and similarly in the case of expenses, those expenses which relate to the next accounting period, and expenses which have been incurred but not actually paid but relate to the current accounting period. So now we come to another financial statement known as the balance sheet. So what is the meaning of a balance sheet? Balance sheet normally is a statement of assets and liabilities of an entity as on a particular date. So this is the main distinction between profit and loss and a balance sheet. Balance sheet is always as on a particular date because it gives the position of assets and liabilities, whereas the profit and loss is for a particular period. That means it talks about income and expenses received or incurred by the entity during a particular period, normally 1 year. So normally when we write profit and loss account, we say profit and loss for the period from, let us say, 1st April 2011 to 31st March 2012. In the case of balance sheet, we say statement of assets and liabilities as on 31st March 2012. Why this is done? Because the position of assets and liabilities keep changing on a continuous basis. So what is shown on 31st March may not be there on the 1st of April of the following year. So it always gives you a position as a particular point in time. So this you have to be very careful. So we always write balance sheet as on 31st March of a particular year. The balance sheet is prepared only after the profit and loss is prepared, because some items which find a place in the profit and loss account get transferred to the balance sheets. And as we must have all seen or known, both the sides of the balance sheet must tally. That means the total of the asset side of the balance sheet always tallies with the total of the liability side of the balance sheet. This is on account of the concept of double entry bookkeeping adopted by us in recording of transactions. And once this is done, we have to understand how the balance sheet is shown. Normally, as we have seen, there are two sides to the balance sheet. Normally the left hand side we show the liabilities, and on the right hand side we always show the assets. Assets normally represent debit balances in the books of the entity. So there should not be any confusion. Normally there is a tendency to think that an asset is always a credit balance, because it is a misconception. A debit balance in a balance sheet always means an asset, whereas a credit balance sheet in a balance means it is always a liability. So all the debit credit balances will appear on the left hand side of the balance sheet as liabilities, and all debit balances appear on the right hand side of the balance sheet as assets. Normally, in order to make the balance sheet amenable for further analysis and interpretation, the assets and liabilities are arranged in a particular order or fashion. So, how they are arranged? They can be grouped either on the basis of liquidity approach or permanence approach. So, these are the two methods of classifying the different items both on the asset and the liability side. Liquidity approach means we have to list those assets which are more liquid first and go on to those assets which are least liquid. That means the most liquid asset is put first and slightly lesser liquid asset is put next, so on until we reach the asset which is the most illiquid. That is called the liquidity approach. And in the case of a asset side, how will you follow this approach? Normally we know that cash in hand, cash at bank are the most liquid of the assets because they are already in the form of cash only. So, we start with cash in hand, cash at bank, that is bank balance, then investments which can be converted into cash at short notice. Then we have sundry debtors, that is receivables to be recovered from the debtors. Then we have stocks of finished goods, then stocks of raw materials, stocks of semi-finished goods. Then you have fixed assets such as machinery, furniture, then intangible assets such as patents and goodwill. This is the order in which the assets will be classified in the balance sheet in terms of the liquidity approach adopted. And if the permanency approach is adopted, what is the meaning of permanency approach? In the case of permanency approach, what we list is, we list all those assets which are there for a longer term in the business, which are used for a longer term in the business, and those which are most liquid are presented last. That means those assets which get converted into cash are represented last, and those which will be staying with the entity for a longer time will be presented first. So, according to that, fixed assets will be shown first, current assets will be shown last, and within fixed assets you can start with the other way. Goodwill and patents will come first, followed by furniture, machinery, and stock of finished goods, stock of raw materials, stock of finished goods, sundry debtors, investments, cash at bank, cash in hand. So, as you can see from here, this is exactly the opposite of what we did in the case of liquidity approach. And in the case of liabilities also we have to arrange. One way to list the items of liabilities is to start with capital, followed by long term liabilities, and lastly short term liabilities. So, the first item is always capital, and then long term liabilities and short term liabilities. Another way is to start in the opposite direction, that is first show the short term liabilities, followed by long term liabilities, and finally the capital. So, here let us now go into the broader classification of the assets and liabilities. In the case of assets, they are classified into three broad categories. One is called the fixed assets, other is called the miscellaneous assets, third is called the current assets. And sometimes long term investment also can be shown as a separate category. So, in some of the entities they can show, in addition to fixed assets, miscellaneous assets and current assets, they can also show investment as another category. So, now let us consider each one of these as to what they indicate. In the case of fixed assets, they can be further classified into two categories. One is called tangible fixed assets, other is called intangibles or intangible fixed assets. Tangible fixed assets normally comprise of land and buildings, plant and machinery, furniture and fixtures, vehicles, etc. Whereas intangibles include such as goodwill, patent rights, designs, brand names, deferred advertisements, etc. come under the intangibles. And in the case of current assets, normally we include those assets which can be converted into cash or already in the form of cash within a short period, normally within a period of 1 year. So, current assets include cash in hand, bank balances, stock in trade or what we call inventory, and then sundry debtors also called receivables, then bills receivables, repayments, advances, etc. All these comprise current assets in the books of the entity. And in the case of liabilities, normally liabilities are classified into two categories apart from capital. One is called current liabilities, other is called long term liabilities. Like in the case of current assets, current liabilities are those liabilities which need to be met within a period of 1 year normally. So, they include short term borrowings that is normally bank borrowings in the form of cash credit, overdrafts, etc. Sundry creditors are also known as payables, that means the money to be paid to the suppliers of goods. Then bills payable, outstanding expenses like outstanding salaries, outstanding wages, etc. Advances taken and provisions made for taxes and other things. So these are liabilities which need to be met within a shorter period of 1 year, and long term liabilities include those liabilities which need to be met for a longer period. For example, term loans are liabilities which need to be met over a period of 5 to 7 years, or they could be fixed deposits taken by the entity for longer tenure of more than 1 year. So they are all classified as long term liabilities. And in the case of provisions and reserves, we have to find out the difference between the two. Provisions are any amount written off or retained by way of providing for depreciation, renewal or diminution in the value of assets, or retained by providing any known liability of which the amount cannot be determined with substantial accuracy. So they can pertain to assets where we want to provide for depreciation or diminution in the value of the asset. For example, we want to provide for diminution in the value of receivables. Suppose we find that the sundry debtors, some of them could be turning into bad debts at a point in time in future. So we want to provide for that as a precaution. So that is accounting for diminution in the value of the asset. So that is treated as a provision. That means we are trying to set aside a certain amount of money to take care of that eventuality of not being able to recover that amount. Similarly, it can be to provide for a known liability which cannot be ascertained now. For example, we want to provide for taxes. The actual taxes can be determined only at the end of the year, but before that we want to provide separately for taxes based on past data. So that is a provision for a known liability. Or for example, there is a suit filed against the entity, and in which you anticipate that a certain amount needs to be paid to the party which has filed the suit. So you provide separately for that. Or let us say you have a wage agreement which is under discussion with the employees, with the workers, and you need to provide certain extra money towards wages of the workers. So you can set aside a certain portion separately as provision for bonus or wages or whatever it is. So it is providing for a known liability, but the extent of the liability cannot be determined with accuracy at the present point in time. So normally provisions can be for depreciation, provisions for bad debts, provisions for taxes, etc. Provisions are always a charge against profits. That means they are taken out of the profits. The profit and loss account is debited and these provisions are made. Whereas reserves are entirely different from provisions. Reserves are profits retained in the business and not having any of the attributes of a provision. That means they are out of the profits already made by the entity. They are not a charge on profits, they are an appropriation of profits. That means they are appropriated from the profits. Reserve fund signifies the amount standing to the credit of the reserve that is invested outside the business in securities which are readily realizable. Once the reserve is created, that money is kept apart, normally invested in certain other securities, so that the amount can be used in times of need. Now let us talk a little bit about the limitations of the financial statements. We have already considered what is the meaning of a balance sheet, what is the meaning of a trading and profit and loss account, and now let us try to find out as to what are their limitations. The most important limitations are as under. One is they are based on records based on historical costs. That means they are prepared out of records based on historical costs. So what is the problem here? The problem is once they are recorded as per historical cost, irrespective of what the changes might take place in the economy or in the value of the assets and liabilities, they continue to be shown at historical cost. So comparison becomes difficult. For example, if land is purchased at a certain point in time, let us say for 1 lakh rupees, the value of the land continues to be shown in the books of the entity at 1 lakh, though its value may have gone up many times over in the years that followed, but still it will continue to be shown at the historical cost. So if you use historical cost, it will not give you a fair idea as to what is the actual position of assets and liabilities of the entity. That is one of the drawbacks of the financial statements drawn on the basis of historical costs. But for want of a better method, we continue to follow the system of recording transactions at historical costs. And the second is intangible strengths and weaknesses. Balance sheet, as we know, or profit and loss, as we know, are only entries which can be put through in the books of accounts. And as we have seen earlier, only those things which can be measured in terms of money can be recorded. Other things which cannot be translated in terms of money cannot be recorded. So that becomes one of the biggest drawbacks of the financial statement. For example, you may have very good brand name, you may have lot of goodwill generated, or you may have an excellent human resources, value of which cannot be ascertained. So these do not find a place in the balance sheet or the profit and loss account. So to that extent they suffer. Suppose you want to compare two entities, one having excellent human resources, another having not so excellent human resources. On the basis of their balance sheet, you cannot make out as to which is the entity which has got excellent human resources, because these do not find a place in the financial statements. To that extent, it is a weakness of the financial statements. Then perpetual continuity and periodical account. Normally an entity is there in existence for perpetuity. That means it is in the business for an extended period, and we try to artificially cut down to accounting periods. Accounting periods are nothing but periods taken out artificially from the total life of the entity. So this may not be useful, because we may be taking a particular period which may not show the entity in better light. For example, if it is a seasonal industry, and if you are closing the accounts at a different point in time when the activity is not so high during the off season, then it may show another set of position, whereas if the balance sheet is prepared during the season, it may show another set of position. So that is one of the drawbacks of the financial statement. And next one is different accounting policies being used by different entities in preparation of the financial statements. Though as we have learnt that accounting standards have been introduced with the objective of trying to reduce the different choices available to entities in the preparation and presentation of financial statement, but still this cannot be totally ruled out. They still have many cases where there is a wider choice to the entities in adopting certain accounting policies and principles in the preparation of their financial statements. So since each entity has got that kind of freedom to choose a particular accounting policy, to that extent the financial statements become incomparable with the financial statement of another entity which is following a different accounting principle. And then last is management policies. Management policies also play a very important role, because lot of decisions which the management takes will go into making up the profit and loss and balance sheet of an entity. For example, valuation of inventories. This is a management policy as to what valuation principles to follow. Though there are certain guidelines laid down in terms of accounting standards, still there is a lot of leeway or an option given to the managements to pursue certain kinds of policies in the matter of, let us say, valuation of inventories, in the matter of valuation of fixed assets, in the matter of valuation of investments, in the matter of adopting a particular method of depreciation. So management policies also can have an effect on the financial statement. To that extent, financial statement need to be analyzed, keeping in mind what kind of management policies are being followed by that particular entity. Now we will go to the next financial statement known as the cash flow statement. So as you are aware, the three important financial statements are: one is the profit and loss account, second is the balance sheet, third is the cash flow statement. Normally it is now made mandatory for finalizing the cash flow statement and publishing it in respect of all listed companies. It has become mandatory, and there is a separate accounting standard, as we have seen, it is called AS3, which details as to how to prepare the cash flow statement. So, before we go into the details of preparation of the cash flow statement, we will try to understand what is the meaning of a cash flow statement and what is the use of the cash flow statement, and then we will consider as to how the cash flow statement can be prepared and then what conclusions can we draw based on the cash flow statement of an entity. So, let us start with the definition of the cash flow statement. A cash flow statement is a statement which shows cash inflows, cash outflows and the resulting change in the cash balance between two balance sheet dates. That means, normally we try to consider the cash inflows and the cash outflows between two balance sheet dates, that means during a particular accounting period. And what it does is, it tries to match the cash balances at the beginning of the period with the cash balance at the end of the period. That means, if the cash balance has gone up during that period, it means that excess has come from the net of cash inflows over the cash outflows. If the cash balance has gone down, it means the decrease is on account of cash outflows being in excess of cash inflows to that extent. So, what is the meaning of cash inflows? Cash inflows means cash which is coming into the organization. Normally, this is in the form of income. Whenever sales are made and cash is received, we will have cash inflows. Cash outflows are outflows of cash. Whenever expenditure is incurred and the actual cash is paid out, it results into a cash outflow. So, there you have to distinguish between an actual income and a cash inflow, and an actual expenditure and a cash outflow, which are not the same. So, what happens in the case of an income? Normally, as we have seen, based on the accrual system of accounting, we take all incomes as income whenever the entity gets the right to receive that income. So, whether or not cash is received, it is treated as income. Whereas, in the case of cash flow statement, we will take only those cash inflows where actually cash has flowed into the entity. Similarly, cash outflows means only those expenses which have been actually paid. So, that means expenses which have been incurred, but where cash has not been paid are not taken in the cash flow statement. And net cash flow is defined as the difference between the cash inflows and the cash outflows. So, net cash flow can be either a net cash inflow if the excess of cash inflows were the cash outflows, or it can be a net cash outflow when the cash outflows are in excess over the cash inflows. And cash here means cash and cash equivalents. Cash includes not only cash but also cash equivalents. And what is the need for a cash flow statement? Normally, for that we have to understand why cash is needed and what is the use of cash in an entity. Availability of cash generally determines the ability to meet the maturing obligations. The more the entity has cash balances, it has the ability to meet all the obligations which will be maturing over a period of time. Therefore, it is necessary to have cash balances on hand. If cash is readily available, then the current obligations can be met. If it is not available, current obligations cannot be met. And if current obligations cannot be met, it may result into some kind of problems for the entity known as technical insolvency. Therefore, it is necessary for the entity to maintain a desirable level of liquidity at all points of time. That means the entity should be in a position to meet all its obligations which are arising in the shorter period of time, normally considered to be 1 year. So, therefore, the entity should be interested in knowing what are the cash outflows and inflows during a particular period, and what should be the policies which the entity should adopt in order to have an effective control over the cash inflows and the cash outflows. For this purpose, the preparation of the cash flow statement becomes necessary. And let us now go into the details of the various components of the cash flow statement. So, as we have seen, there are cash inflows, also known as sources of cash, and cash outflows, also known as uses of cash. So, normally sources of cash are the following. One is cash from operations, that means the business in which the entity is currently engaged in also will result in certain cash coming into the entity on account of that. They are termed as cash from operation. For example, if an entity is a manufacturing sector and they are manufacturing a particular product, by the sale of that product the company or the entity will generate certain cash. Such cash is known as cash from operations. Then cash can also be received from the entity by issue of shares, that means by raising capital from the public the entity will get cash, that is also another source of cash. Similarly, issue of debentures will result in cash inflow into the entity. Raising of long term loans either from financial institutions or commercial bank or from any other source will also result into inflow of cash. And lastly, the sale of fixed assets also will result into cash inflows into the entity. The cash can be used for various purposes. One is of course redemption of preference shares. If preference shares have to be redeemed, that means money has to be paid out to the preference shareholders. Similarly, redemption of debentures, that means payment to debenture holders at the end of the maturity period or at any time when the company decides to redeem the debentures. Then repayment of loans taken from the banks, financial institutions, etc. will also result in an outflow of cash. Then purchase of fixed assets also results in outflow of cash. Payment of dividends to shareholders also results in outflow of cash, and finally payment of taxes is also a use of cash, that is an outflow of cash. So now we will have to make a distinction between the net cash flow and the accounting profit. As we have seen, profit and loss account will give you an idea as to what is the total income generated by the entity and what are the total expenses, and the resulting balance is termed as net profit. Whereas in the case of a cash flow statement, we take into account cash inflows and the cash outflows, and the resultant balance is called the net cash inflow. So whether net cash inflow is same thing as the accounting profit? If not, what is the reason why both are different? Because in both cases we are talking almost of income and expenditure. So what happens in the case of a cash inflow is we only take into account only cash flows, that means only those flows which result into receipt of cash or use of cash, but we will not be taking those which result into income but not result into cash inflow. So normally all sales made on credit will not result into any cash inflow but will be taken as income. Similarly, there could be cash outgo in the form of expenditure, but all expenses need not be resulting in cash outflow. For example, expenditure incurred but not actually paid are also taken as expenditure in the profit and loss account, whereas there is actually no outgo of cash. Similarly, there could be other expenses which are in the nature of book entries which do not result in outflow of cash, such as depreciation. Depreciation is a book entry charged in the books of the entity in order to take care of the expenditure relating to the wear and tear and use of the particular fixed asset, but it does not result into any outflow of cash. So if you want to compare the actual net cash flows with the accounting profit, we need to consider non-cash revenues and non-cash charges. So one has to be reduced from the net income and the other is to be added to the net income. Therefore, net cash flow can be termed as net income, that is profit and loss account net income, that is actually the accounting profit. From that you have to deduct all the non-cash revenues and add all non-cash charges. The example of non-cash revenues, as I have said, is accrued interest, that means interest which is accrued but not yet received. Similarly, sales made but money not received, these are all examples of non-cash revenues. Similarly, examples of non-cash charges are depreciation and amortization, where they have been put as expense in the profit and loss account, but there is actually no outflow of cash. A deferred tax also is a non-cash charge, that means a deferred tax is something where the tax payment is deferred, but it is treated as an item of expenditure. So, there is no outgo of cash, but it is also treated as a non-cash charge. So, therefore, we always talk of cash inflows, net cash inflows as net income plus depreciation, because mostly in other cases all other non-cash charges are 0. So, by and large in many entries only the non-cash charge which is put in the books of the entity is the depreciation. Therefore, normally to simplify things they say net cash inflow is equal to profit plus depreciation, that is the normal definition given, but you should remember that by and large theoretically it should include all non-cash charges if they are incurred by the entity. So, now we will come to the statement of cash flows. Once having considered what is the meaning of cash inflows and cash outflows, it is necessary to find out the different kinds of cash flows. And why is it necessary to find out what cash flows are necessary? Because cash is a very important source for the entity. Even if a company is making a large income during a year, the cash it has generated may not be that large, because it may have a lot of non-cash revenues and non-cash expenses, and because of that the accounting profit as shown in the profit and loss account may not give us an idea as to whether the entity will be able to meet its liabilities which result in the outflow of cash, such as payment of dividends or purchase of more inventories or to finance more accounts receivables, that is sundry debtors, to invest in fixed assets, that is purchase of buildings, machinery, etc., or to reduce debt, etc. So, for that we need to know what is the exact cash position. Therefore, a cash position needs to be separately ascertained by preparing what is known as a statement of cash flows. So, to summarize in a nutshell, the following factors affect the cash position of an entity. One is the net income. If the net income is more, ordinarily cash inflow will also be more. Non-cash adjustment to net income. If there are more non-cash adjustments to net income, then naturally cash inflow will be more, because to that extent our net income has gone down because of adjustment of non-cash income. Changes in working capital also affect the cash position. Fixed assets changes also will affect the cash position, because you would have used the cash either to purchase new fixed assets, or you would have generated cash by sale of old fixed assets. And securities transactions which relate to issue or buyback of shares. If the company issues shares, that means it is generating more cash. If it is buying back shares from the existing shareholder, it is using the cash. So, all these factors affect the statement of cash flows, and this is what we try to detail in the statement of cash flows. And in order to make the the cash flow statement amenable for analysis and interpretation, it is conveniently divided into three kinds of activities. One is known as the operating activities, second is called the investing activities, third is called the financing activities. So, let us now try to understand what is the meaning of these activities. Operating activities include net income, depreciation and changes in current assets and liabilities other than cash, short term investment and short term debt. That means all operations which result from the operations of the entity are treated as operating activities. And investing activities include investments in or sale of fixed assets. That means any use of cash or inflow of cash on account of either purchase of fixed assets or sale of fixed assets are included as part of investment activities. They are called investing activities. Similarly, financing activities include raising of cash by either selling short term investments or by issuing short term debt or long term debt or stock. So, if you issue new shares, it is part of the financing activity. That means company is getting more funds. And similarly, if you borrow money from a bank, it is a financing activity, or if you repay a bank loan, it is treated as a financing activity. So, the statement of cash flows is used to find out whether the company is generating enough cash to purchase additional assets required for growth, whether it is generating extra cash that can be used to repay debt or to invest in new products. Basically what we are trying to find is, if an entity is undertaking a particular operation, whether it is able to generate enough cash so that that cash can be used for two purposes. One is to repay the debt, so as to reduce the debt burden of the entity, or to purchase new fixed assets so that the entity can continue to grow. Such information is very useful, particularly to the top management as well as the investors. Investors would like to know as to whether the entity has the ability to generate cash requirements to take care not only for the growth of the entity but also for payment of dividends to the shareholders. And in the case of management, management is interested in knowing whether the entity is able to generate enough cash so that they are able to take care of the growth needs of the entity. And now we have a specimen of the cash flow statement which normally appears along with the other financial statements such as profit and loss account and the balance sheet of the entity. So there, as you see from the backboard, you can see that it is again divided in the same fashion into operating activities, investing activities and financing activities. If you have a look under the operating activities, you see items such as net income. This is the profit and loss which is taken from the profit and loss statement. Then we need to make certain adjustments on account of the fact that profit and loss account has certain non-cash charges as well as non-cash income. So all these are adjusted to arrive at the actual cash provided by the operating activity. Therefore we take into account adjustment on account of depreciation, adjustment on account of increase in receivables, increase in inventories, or increase or decrease in accounts payable, increase in accruals, etc. And the resultant balance is shown as the net cash provided by the operating activities. If it is shown in the brackets as in the example shown, it means net cash flow means it is a net cash outflow. If there is no bracket, that means there is a net cash inflow. And coming to the other two activities, that is, one is the investing activities, the other is called the financing activities. There you see the cash used to acquire fixed assets is shown under investing activities because it is a part of the investment activity of the entity. In the case of financing activities, we have shown sale of short term investments, increase in notes payable, increase in bond outstandings, payment of dividends. Then we arrive at the net cash provided by the financing activities, and once this is done, we combine all the three net cash flows provided by the three activities, we arrive at the net change in cash. To that we either add the cash at the beginning to arrive at the cash at the year end. So from the above example we can see that there has been a negative cash inflow in the case of operating activities and financing activities, whereas there is a positive cash inflow in terms of financing activities. What is the meaning of this? That means the entity has not been able to generate cash from its normal activities. So it has to generate activities from the financing activity, that is by means of borrowing. So the company has borrowed money to pay for the shortfall in the investing activities as well as the operating activities. So a statement of cash flow is a very useful statement which is used both by the investors and the top management to arrive at certain basic decisions.